Good afternoon, everyone, and welcome to the New York Alternative Investment Roundtable podcast for February 8th, 2022. I'm Robert Atkinson of the Riverside Management Group, the moderator. We are very pleased to welcome Antonella Pucca. Antonella is a managing director with MPI Business Valuation and Advisory, where she specializes in the valuation of private equity and venture capital-backed companies for financial and tax reporting, M&A transactions, buy-sell agreements, estate planning, and litigation purposes. She is also the author of Early Stage Valuation. There it is. And was named the 2021 Volunteer of the Year Award, Valuation Services, of the American Institute of Certified Public Accountants. I've known Antonella for many years, and I would describe her as a proven thought leader in this very important and complex aspect of investing. Today, there is roughly $900 billion of investor money earmarked for venture capital investments. But how do you value an early stage organization that hasn't generated any revenue yet? I'm sure many in our audience have wrestled with this tremendous challenge, and I am confident that you will find Antonella's insights to be very comprehensive and highly useful, and would encourage you to reach out to her after our program. Just a few additional words about our guest. Antonella has more than 20 years of experience in the alternative investment industry, with particular expertise in providing valuations of early stage companies at fair value to private equity, venture capital, and hedge funds, including the use of option pricing models and Monte Carlo simulation. Her expertise also includes valuation of financial instruments of privately held companies. In addition, Antonella has valued companies in most major industry groups, including technology, healthcare, mining, manufacturing, utilities, telecommunications, retail, and service industries. She serves on the Business Valuation Committee of the American Institute of Certified Public Accountants and as a consultant on the CFA exam development team. Now, before we dive into this timely and very interesting topic, I do want to thank our sponsors for their ongoing support of the Roundtable and this podcast. And as you can see on the screen, they include Alston Bird, Baker Tilly, Bloomberg, Deloitte, Grant Thornton, New Mountain Capital, Mirae Asset Securities Prime Brokerage, and our nonprofit sponsors, Kaya, the United Kingdom Department of Trade, and the Grand Duchy of Luxembourg Trade and Investment Office. Just a reminder to everyone, Antonella will be answering my questions for approximately 45 minutes, and then we'll open it up to the audience for questions. However, at any time during the podcast, you are able to send questions to me for her by using the tools at the bottom right-hand corner of your screen. So I would highly encourage you to do so. Now, let's get to it, folks. Antonella Pucca, it is terrific to have you join us. We are very excited to hear your views and insights on early stage valuation in venture capital. So, Antonella, early stage valuation is a broad category. How do you define a company that is an early stage?
Well, thank you very much, Bob, first of all, for the introduction, and thank you for all the participants who are here with us today. It's a pleasure to participate in this podcast. And to respond to Bob's question, early stage valuation affects a broad range of companies. And for purposes of my book and in general, for purpose of a valuation analysis that we will discuss today, we define early stage as companies that are not yet profitable. So you may have companies in a broad range of sizes. You can have a very large company that has a significant amount of revenue, that has hundreds of employees even in some cases. But to the extent that that company is not yet able to generate profits and a certain level of free cash flows, that company will still fall under our classification. So we are going to range from companies that are true startup that perhaps don't even have yet a product, all the way up to companies that may generate revenue but are not yet profitable. And the reason, just to conclude on this, I mean, the reason why this is relevant is because to the extent the company is not profitable, it has to rely on external funding to continue to grow, and that's what puts it in a kind of separate category.
Thank you, Antonella. Now, what are some of the main challenges in valuing an early stage company versus companies that have a history of profitability?
Well, to the extent the company is not profitable, there are questions on how you can effectively apply a traditional technique to the company, like the discounted cash flow method. And we will see that there are ways to still use it, but there are certain qualifications because, one of the assumptions of using a discounted cash flow method is that you have cash flows that are available to the equity holders. And in a situation where essentially all the cash is needed for the company to grow and the company is not self-sufficient, there are other methodologies that may be as relevant or perhaps even more relevant than a DCF analysis in the valuation. Also, another feature of these companies is generally that they have high rates of growth. So, I mean, obviously you can have a startup that's at the very beginning, but, many of the companies that are qualified as early stage under this definition may have already revenue and may be growing that revenue fairly quickly because they are, in a growing phase. And to that extent, one of the challenges is you are dealing really with, if you can think about it, it's like a teenager. It's somebody that's growing really rapidly. It has a bright, perhaps, future ahead, and you have to try to see through, the background of this person and its potential to figure out what the person is going to do, later in life. And that's the situation sometimes that we're dealing with. So there is there are challenges related to forecasting ability, and there are also challenges related to the fact that there may not be comparables in the market, the usual public comparables that we all use when we value companies that, may not be all that comparables after all, because the company is idiosyncratic, it has its own product, it has its own new business model, that's part of why it's so interesting and attractive for an investor. And, traditional methodologies like the DCF, like the guideline public company method, may apply, but they have to be somewhat tweaked to consider the special nature of the company.
Yes, and by the way, I really appreciate your analogy, and it suggests to me that I guess they need to be fed constantly and watched.
Well, and that I should say I do have a teenage daughter.
So firsthand. When you and I had a chance to visit recently, one of the things you brought up, which I thought was very interesting, was the subject company transaction method. Now, how does this apply to early stage valuation?
Okay, the subject company transaction method is a methodology that basically looks at transactions in the company's own stock or securities more broadly to use that pricing information as a basis to value the entire company and to value the other equity interests in the company. So the idea behind the subject company transaction method is the old idea, you look at the latest round, and then you use that price essentially to reprice everything else. Now, the industry as a whole has been moving away from the idea that you can automatically apply the price of the latest transaction to all the share classes. So if you have, and part of the reason is that, if you think about it, these companies tend to have a complex capital structure. So they have a structure where you have multiple layers of preferred. Some of them are going to be more senior, some are more junior rights. They may have different liquidation preferences. And then you have common stock, and you may even have other instruments. Typically, you have, plenty of options. You have warrants. You may have safes, convertibles. So you have to deal with this cap structure. And if you have a round, for instance, at a Series D round, that round, chances are, is going to be the most senior in the cap structure. And if you apply that price to the common stock, to some extent, you may be overvaluing the common stock, because you are kind of placing the common stock to the same level of rights that the preferred that the most senior round of preferred is placed at. So you need to consider the seniority rights and the economic rights and other rights of the various classes of securities. And you can use the price of the latest round, but you kind of can use it to back into an equity value for the company that considers the liquidation preferences and the economic rights of all the other equity interests. So, yes.
I was just going to say, Antonella, so if I understand you so far, what you're saying is that the method helps us to establish a valuation peg that is appropriate for each class of stock, each individual class of stock.
That's correct. So basically, the process would work like you start from the price of the latest round. Given the company's capital structure, you back into a value for the equity that's consistent with the price of the latest round.
And if I can ask you, just talk a little bit about the cap structure of these companies for the audience. What is a typical, not that there are typical companies, but all things being equal, what type of cap structure would you see in such or with such a company?
So in most cases, and I'm talking also about the sort of like the most common traditional model, for a early stage, what you would see, you would have founders that have common stock. And then you would have typically, as the company starts raising capital from third-party investors, those investors would typically enter the company with preferred equity. So they will negotiate equity rights, so they will qualify as shareholders and stockholders, but they will negotiate also some sort of liquidation preference that goes with their investment, that give them higher protection and title to the company's distribution. So just in case the company, for instance, the business doesn't go all that great, and they want to cover themselves ahead of the common shareholders. So and then in addition to that, you may have other instruments. Typically a company would issue options to their employees. They may issue warrants under various circumstances, in some cases as a kickback to convertible bond issuances. And they may have a range of convertible securities, including convertible bonds, and including also, perhaps more sophisticated instruments like safes. Okay. So that's typical.
Okay, very, very interesting. So what you've also said then is there are both economic and non-economic considerations that get factored into each one of these classes.
That's right. And the subject company transaction method provides you with a system to essentially peg your valuation to the price of the latest round, which is a market input. Also for financial reporting purposes, is considered a market input, and then back into the equity value of the company, and then allocate that value down through the company cap structure to the various equity series and classes of equity instruments.
And we could consider the valuation peg in effect to be comparable to, let's say, a print that we might see in the public markets.
Well, yes, to some extent, yes, that's a good analogy. Yes, in a way, these companies obviously don't have trades in the exchanges, so the closest that they're ever going to come to public market information, in the lack of a public market, is by looking at what third-party investors are able to negotiate with the founders and with the other shareholders to be able to enter into the company as a new shareholder.
Yes, and just pivoting a second, I know many of us on the call are very familiar with the DCF method, a discounted cash flow method. Can DCF be applied to an early stage company that's not yet attained profitability?
The short answer to that question is yes, but with some qualifications. And the qualifications are due to the fact that, by definition, we are starting with a company that is going to have negative income, so losses essentially, in at least for a certain period of its projections. So the point is that I would say the condition to be able to apply a discounted cash flow method is that you do need to have revenue. You cannot, really apply this methodology if the company is so early in its life cycle that you don't even have revenue projections. So once you have revenue in place, and you have a certain level of confidence that the projections that management puts together are reasonable, you can start, building an analysis that examines the time, that has a timeline, and looks at perhaps you're going to have the first, maybe couple of years where cash flows are still going to be negative, but at some point, maybe from year 3 onward, the company is going to become profitable according to the projections, and then the discounted cash flow method makes sense.
So Antonella, you said it can be applied if the projections appear to be reasonable, right? So given your experience, what would constitute an example of reasonableness here? For example, would a startup company or an early stage company that has contracts in hand about regarding future business, would that qualify?
Absolutely. I mean, that's precisely the point. I mean, this is a situation where, the company may have had a history of losses, but, if there are contracts in place that already give you a ground, to support management projections of positive cash flows going forward because the contracts are already signed and that revenue is going to be generated, I mean, that gives a pretty good level of comfort that indeed those projections are reliable. You don't necessarily, I mean, there are also situations where you can get there in many cases also without necessarily have actual contracts. I mean, if you have contracts, that's great, but many times, that's more, there are more assumptions involved. And in that case, the company needs to have a story. They need to have, a vision of how they're going to develop their product, how they're going to develop their operations, how they're going to develop their staff to get them to the point where they are, those projections are going to take place. So, and to some extent, there is a component of experience, as a valuation analyst, when you approach these companies to, you look at what the company has put together and you kind of get a sense, where the company stands. Does it have a vision or how is the company planning to grow? So sometimes you see, very high growth rates of revenue, but then the company doesn't really have a clear path on how they're going to support that growth. So if you have increasing growth, I mean, you need to have presumably capital expenditure. So you need to have an increase in personnel, and you have to look at kind of all these elements together. What they're building is a realistic story. And that takes some experience, I would say, and also some study of what happened to companies that, even in different areas, but may have followed, some similar paths in the market.
Okay, thank you. And just moving on here, I think it's fair to say, and correct me if I'm wrong, that some of the same factors that drive, let's say, interest in IPOs are also what makes it possible for venture capital to thrive, right? And I think that we see that the environment for IPO exits, or how do you see the environment for IPO exits, especially given what's gone on with the stock market recently? There seems to be a lot more volatility. There's rumblings, threat of additional rate hikes, volatility, et cetera. Has the perspective of the VC investors or VC exits changed in recent times?
Well, that's a very that's a very challenging question. But what I would like to emphasize is that we are coming out of a period of extraordinary opportunities in terms of VC exits in general, and in particular for the IPO market. So I was looking at the latest PitchBook US VC valuation report that came out very recently, and apparently the median step up at exit in 2021 was 1.65x for IPOs versus 1.18 in 2017. And historically, we are, at points that are really, really on the high side. So how are we going to be able to sustain this level of activity? That's really the question. And we have to be mindful of that we are, to some extent, we are in an exceptional situation at the moment. The other consideration is that IPOs, besides IPOs, there are other types of exits now that companies are using more and more frequently to access the public markets. Companies have started using direct listing more frequently. Also, there is the SPAC, the whole SPAC world that's out there. And I would add, so these are the growth of these has been also very strong in addition to the IPO.
Well, so you mentioned SPACs. So it would seem as if the SPAC market, is certainly taken hit some speed bumps in the last year or so. Would you agree? And what has changed about the SPAC market, Antonella? Oops, folks, I think we have a technical problem. Antonella, can you hear me?
Yes, I'm so sorry about that.
No problem. I think you were in mid-sentence there.
Yes.
We were talking about IPOs, venture capital, and pivoting into the SPAC market.
Yes, absolutely. I think I'm back into the video now. I'm gonna top off.
Okay. Go back in.
Sorry about that.
No problem. Just give us another second, please. Thank you. Britt, I think she's dialing in. Can you let her in the room if you see her there? No, she's not. Hold on. Okay, Antonella?
Yes, I'm sorry.
No problem. Why don't we continue this way?
Yes, 100%.
Okay, so again, you were there in mid-sentence talking about IPO exits, venture capital investors exits, and we were just pivoting to the SPAC market. And then I want to turn to some questions that we've received from the audience.
100%. So I mean, basically, the idea is that with the IPO, you do have enhanced regulatory requirements and reporting requirements, not just in order to conduct the IPO, but also afterwards. So, and companies, may prefer alternative solutions or may prefer, a SPAC transition rather than going straight to an IPO to be better prepared to comply with those requirements.
Okay. And let's just swing back for a second. I have a question that came in from the audience regarding a topic we covered a moment ago, and I missed the question. How would you value a company in the pre-revenue phase?
Sorry, can you repeat that?
How would you value a company in the pre-revenue phase?
Okay, so if you look at pre-revenue, now the well, one methodology is you in many cases companies that the pre-revenue phase. I mean, first of all, you have to look at the industry. Each industry has its own feature.
Yes.
At that stage. I mean, we're talking about healthcare companies. I mean, those are companies that stay in the pre-revenue phase for a very long time because they're in the process of developing a product. So in that context, there too, you can look at, you can develop a view of what the potential market share for that company is going to be along the road, and then evaluate the company relative to where they are in that space,
Okay.
based also on their FDA progress.
Okay.
So that's one situation. Another situation is a technology company that may, for a technology company, the technology is like a software company. They may have, in this case, like one asset, which could be a patent or some sort of license, that's unique.
Yes.
And in that case, value of the company is really tied to the valuation of that particular asset. So, so in that case, what you would look at is ways to value essentially, not just the company overall, but the assets, the key assets that the company has. And there are techniques that apply specifically to the valuation of intangibles, like software codes, for instance.
Okay.
So these are all possibilities.
Okay, terrific. So, and let's, you're imparting a lot of information. So I would just maybe slow down just a tad. So what has changed in the SPAC market, Antonella?
Okay, so the SPAC market, we have seen, there incredible growth in the SPAC market, very significant growth over the past 2 years, especially in terms of companies that did a SPAC IPO. So, again, I want to, we can refer to PitchBook reports for that. They give us a pretty substantial data on this company, on the SPAC deals. Also, we have seen, recently a greater shift towards very large SPACs being listed. So those are recent phenomena. Now, the question is that the whole existence of the SPAC is justified in view of the reverse merger transaction that they're planning to execute within typically 2 years from the IPO. So each SPAC that goes to the market has an intention at inception to do a merger within, let's say a 2-year time frame. Now, with more and more SPACs accessing the market, the question becomes how many of these are really going to be able to successfully complete a merger transaction. And a second question is, we also want to make sure that that merger transaction eventually is successful for the investors. So
right.
What happens to the merger after, to the company after the merger has taken place, and does the stock price after the merger justifies investing in a SPAC or maintaining an interest in the target company after the merger has happened? And that's where the challenge is. So today we have, a great deal of SPACs that are out there. Historically, we have assumed in many cases in valuation models that 10% of these mergers won't happen, but 90% will. And are these percentages going to still be realistic? Number one, and number two, what's going to be the trajectory of the company after the merger?
I see. Very nice. Very nice. There's a follow-up question here on SPACs from the audience. What are the main challenges in valuing shares of the target company before the SPAC transaction is completed?
Okay, so that's I mean, I like this question because in many cases, we tend to focus more on valuing, the warrants that the private warrants of the SPAC itself or the founder shares. And here we're shifting the perspective to the target company shareholders. And there is an assumption sometimes that, automatically if there is a merger transaction, shares of the target company, I mean, the shareholders are going to get a gain. Well, that's not always the case. And part of it has to do with the dilution effect that takes place when the merger is executed. So the merger transaction is going to bring cash to the target company, but it's also going to bring a good deal of new stakeholders in the company, which include the SPAC founders, and they include the SPAC shareholders at the time the SPAC transaction takes place.
And can I just ask you a quick question? So, before all that happens, don't the shareholders have the right to vote on that, right? So, if the shareholders have placed capital into the company, then they get to vote on whether to de-SPAC. Is that not the case?
Yes, it is the case, but there are a lot of factors that there are a lot of situations that take place in these votes, and the equity holders in the target, typically the target company ownership is also layered. So you may have founders of the target company that have an interest in getting the merger done, but maybe, the minority shareholders may not have all the benefits of the merger. So I think, there is a component of that needs to be evaluated. And again, here, like, in other situations that we've seen for these companies, we need to really pay attention to the cap structure, understand what's going to happen after the de-SPAC takes place in terms of the new resulting cap structure. And then, based on that, we can have a better sense of what the situation of the former shareholders, particularly the preferred equity holders of the target, is going to be.
I see. Okay. Now, and thank you, Antonella. Just to change gears for a second, I think all of us on the call probably know this to be true, that these days you really can't have conversations without mentioning, to one degree or another, crypto assets. And so with the dramatic rise in the number of companies that operate in this space, how do you see this market of evolving? And what are some of the challenges, the big challenges in valuing crypto assets? In general terms, and then let's talk about some specifics like tokens or simple agreements, but let's talk first in general terms.
Yeah, so thank you for this question. I mean, in my practice, I've definitely seen an increase of interest in this type of assets, which has been quite rapid and quite dramatic. And the interesting thing is that, some of the large VC players are in it. And so it's not just a game or a kind of diversion for small investors. I mean, this has become a market trend, and it's a market trend that we need to try to understand, and that is there to stay. I mean, in some form or another, these crypto assets are changing the way we look at money, and we look at electronic transactions. So I think it's imperative for us in our profession to address this market and get our own view of how it's evolving. Having said that, so it's still a market where there is, it's moving very quickly. There isn't a lot of regulation, or if at all, in certain areas, so that it creates some challenges. I mean, I would say the first thing that I think about when I get one of these assets for valuation is to try and understand the terms of the transaction. So in some cases, there's some basic terms which are common, but each contract may have its tweaks. Each company has its own specificity, and there's a lot of information on the web sometimes, but we need to also make a judgment of how reliable that information is. So getting a good description of the company, what the company does, what's in their cap structure, and how does the particular security fit into the cap structure, that's already, a challenge, and it's a important part of the valuation process. And then once that's developed, we have to look at the specific type of assets, and the approach is going to change depending on the type of assets that we're dealing with.
Okay, so let's talk about some specific types of assets in the crypto space, right? Let's talk about tokens, exchange traded, and those that are not exchange traded. How would you approach those or these?
Okay, so for exchange traded tokens, we at this point, there are some reference websites that provide pricing that CoinMarketCap, for instance, is one of them that is used in the industry. I think there too, once you identify the token, you associate it to a specific ticker on one of these websites, you can get pricing information out of the website. And generally, and the question is then is again, it's a question of understanding to some extent the nature of these tokens. So where do they trade? Do they trade on U.S. exchanges, or do they only trade, some in offshore exchanges? And how does that match the valuation policy of the particular fund you are dealing with? Do they have special provisions concerning these tokens, or can you use? Do you need to look at the U.S. exchanges exclusively, or can you consider also getting information from exchanges that are not local? And also, a very important consideration is these are assets that trade around the clock. So there is not like a 5 p.m. close. So which close are you going to use if you want to use a close? Are you using Pacific time? Are you using New York Times 12 p.m.? Are you using for US GAAP purposes that you are supposed to use an exit price? And sometimes the fund agreement may mandate that instead you use an average of the daily high and low. So is that compliant? So all these are questions that you need to think about when you're dealing with the tokens.
Okay, let's pivot now to simple agreements for future tokens, and maybe a good place to start there is just to give our audience a very pithy definition of what they are.
Okay, so here we're trying to get into really the crypto, some relatively new type of contracts in the crypto world. So this is basically an agreement to buy currently tokens that don't currently exist, but with the idea that these tokens are going to be issued at some point in the future. So you kind of lock in a price now for something that with the idea that it will be issued.
So a call option. You're buying a call option.
It's similar to a call option, but I would say it's not an option because you have bought them.
Okay.
You have pre-bought them. So it has features of a call options, absolutely, because you don't really know, eventually at the price at which these tokens are going to be issued, but you have locked in your purchase now.
What happens if they don't get issued?
Well, then this is worth nothing. So that's exactly the point, is that, this is a concern in buying these tokens. Having said that, the question is also, the company may still issue the tokens, but if the tokens don't start trading at the adequate level, or that there is no real market for these tokens, even if they're issued, your contract essentially is going to be worth zero. So, assessing, and at the moment, the challenge here is that there is certainly a probability that these tokens are going to be worth zero, and that they're not going to be issued, or that they're going to be issued and they're never going to, even start having a real market that we need to consider, and that probability is not zero, is above zero. We don't have historical information at the moment that tell us that give us, a solid ground to determine what the probability is, but we do have to make some assumptions.
Yes.
And in that case, I mean, going back to what we were saying before, the method of anchoring, basically of using like a subject company transaction method here can help us, because with the subject company transaction, we're saying, well, we paid for these future tokens, $100,000, $100,000. So if we assume that there is like a 20% probability that these tokens are never going to be issued, and then 80% that they will be issued, what's going to be our implied token price, 3 years from now, when we assume that the issuance will take place, for instance.
Yes.
And with that, we can come to a model that we set up as of origination. And then we move forward to your end, and we can update that model to see, if anything has changed. I mean, did the company make any progress? But at least we are anchoring it to something at inception, which is grounded in the purchase price.
Okay. Now let's just pivot here to simple agreements for future equity. How would you value that? And first of all, what are they?
Okay, so here we have a similar type of contract, but this type of contract has been around for like a number of years now, and it's a contract where basically the shareholders, actually not just shareholders, but the investors take on an agreement, enter into an agreement to buy a stake in the next round of presumably preferred equity that the company is going to execute for an agreed upon price at inception. So they basically base the price on, effectively what they negotiate is a stake in the company, and typically this deal have a valuation cap, which tells you what is the maximum price per share that they're going to pay when the deal takes place. So assuming that you want to invest $500,000, you invest that $500,000, but the number of shares that you're going to get will depend on what the next round is going to be, and with giving a cap of let's say $5 million to the value of the company at that round. So based on that, the feature of this agreement is that it comes with a less onerous legal features in a way to put it in place. So it tends to be quick, and it's very common in the VC market. It is a situation where the challenge of this is that you are assuming that this equity round is going to take place. And generally, when these safes started being used, these were kind of thought of as a kind of bridge financing, really, something that you would do, and then 2-3 months later, definitely within a year, the round would take place, and you would convert into preferred equity, and you would become an equity holder in the company. The thing that's happening is that now you have companies that are issuing these safes. So investors are buying them. They are not shareholders because these are not equity stakes. They are future equity stakes that may not come into fruition. And eventually, the round just doesn't happen, or happens, who knows when. And you are left with this contract, which essentially, lingers out there. And unless there is an IPO or a merger or some sort of exit, if the company eventually becomes profitable and decides not to issue preferred, or not to have a preferred stock round, what are you going to do with your safes? So that's something to keep in mind.
So tell us, basically, if it doesn't come to fruition, yes, you're out the money.
Yeah.
Okay.
And again,
and that's all baked into your valuation.
Yes.
That risk.
So, and again, we're dealing with a situation which is, probably not very likely in general, but it's not zero either.
Yes.
So we need to give some probability to this scenario.
Yes. Okay. Let's move on to preferred stock of crypto miners and exchanges. How would you value them?
Okay, here we're getting into a more familiar territory for also non-VC investors. I mean, in this case, we are back. I mean, these are companies that have a crypto business, so we need to understand what their business is and what they're trying to accomplish and how they're planning to generate profits eventually. But the techniques to value them are kind of revert back to our usual, latest round kind of scenario, or looking at the cap structure and so on, and looking perhaps in some cases at the DCF model and so on and so forth.
Very nice. And finally, on the topic of crypto assets, what about joint ventures?
Okay, joint ventures are also a frequent type of entity that we see in this space. This is a situation where DCFs are often used, and part of it is that, in these joint ventures there are, you can see profitability in many cases. You see cash flows that are being generated.
Yes.
Also, in the case of miners, they do have distributions of US dollars, or in some cases, or also in some cases of tokens that take place, and you can value those. So, I would say that the DCF analysis can be especially useful for this type of entities.
Okay, thank you. Antonella, I have a few questions here from the audience. I have a follow-up question to the earlier one that we had on valuation of pre-revenue companies. Not necessarily, not pre-profitability, but pre-revenue, okay? And the question is specific to the industrial sector, not healthcare or software IT, but rather basic industries. How would you approach valuation for a pre-revenue industrial company?
Well, it's a little difficult to do it a bit out of context because, industrial is a very, you have a lot of companies that can fall into that range. I would think that, in this case also, the idea is that eventually the company needs to have a revenue plan. So how much can you rely on that, to build an analysis of the company? That would be my, first approach. And also in terms of market share. So can based on the product that the company is planning to develop, have they made an analysis of what is the market share that they can command, perhaps locally, or depending on which area they want to operate, and based on that, if some sort of revenue and cash flow estimate can be developed.
Okay, terrific. Why don't we move on to here one other topic in our remaining moments, and I would say this topic is similar to the one that we addressed, or you addressed just a moment ago regarding, let's say, cryptos. ESG, a very, very relevant area these days. So how do we approach ESG from a venture capital valuation standpoint? How do we incorporate the non-economic factors that are so important to the nature of ESGs?
Okay, so thank you for this question. This is indeed a very hot topic, and I spent some time also on this, both when I was at CFA Institute and also currently with the ACPA. And one thing that I want to state at the very beginning of this is that from what I've seen personally, my conclusion is the evidence on profitability related to ESG factor, I don't think it's conclusive at this stage. So there's been a research done with different results, and I don't think we can, assert with a high level of certainty that a company that has positive ESG factors, is necessarily going to give higher returns than one that doesn't have such a strong ESG profile. It might be possible. It's logically likely that it might happen over the, at least the medium long term. But again, I don't think the evidence is conclusive. So having said that, what can we do, definitely, ESG factors are important factors for a company's prospects, for its risk profile, and how can we incorporate them into our analysis? So the first thing that comes to my mind is the fact that companies that there are investors in the market these days, and their weight is increasing, which may have objectives that are beyond the pure generating return
Yes.
perspective. So you can have endowments that need to invest they want to invest or foundations that want to invest in areas or in type of investments that are consistent with their mission. You have governments that have political agendas that they have to consider. So you have all sorts of players that for which returns is a consideration, but there are other considerations in their investment strategies. And those investors the presence of these investors affect the market and the capital raising environment in which companies operate, and potentially the exits that investors need to take into account when dealing with an early stage company. So if you are if you are in a certain type of if you have certain qualities from an ESG perspective, you can target perhaps a broader range of investors or a different range of investors than if you are a different type of entity. So the question is, what is the potential market for an exit? And in that respect, the ESG approach for these companies is very relevant. The other area where I see relevance is the risk profile. So
I'm sorry, say it again, please.
The risk profile.
Risk profile, so, yes, okay.
The risk profile of the company is affected by how the company deals with ESG considerations, and that may translate into a different discount rate, for instance. One of the components of the discount rate, for instance, in a DCF model, is the company-specific adjustment. So you look at market, you look at equity returns for the market as a whole, you look at the beta factor, you look at the sales factor, you also look at what is the specific company risk profile, aside from other general factors. And in that assessment, ESG factors can play a role. Or, and another area where it can also affect is in the company cash flow projections. So depending on its ESG strategy, the cost of running its personnel may be different, or the likelihood of incurring in a insurance-related event may be different. So all these items end up factoring into the company valuation at the end of the day. Although you wouldn't necessarily have to use a specific ESG factor analysis, you can still consider ESG as part of your overall company assessment.
Okay. And Antonella, I have another question here from the audience, and let me just see if I can distill this. Basically, with the rise in SaaS service providers, and I've even, I guess, categories, DaaS service providers as well, data as a service. Do you have any insights into how to value those companies, SaaS and DaaS?
Well, I think again, it really depends on first of all, gain an understanding of their business proposition. I mean, ultimately, that's the starting point for, and I think this applies to these type of companies that have new business models more than, perhaps more traditional companies that are easier to, in some extent, to place. But, the first thing is that I think in any valuation, in these companies in particular, is to develop your view of what is their business proposition and how does that fit into their target market, and how are they going to get there? So and also I would add, how you're going to eventually, what is their exit possibility? So yes, you enter into the deal, but with whatever instruments you decide to enter, but how eventually are you going to monetize your investment? That also affects the value.
Yes. Well, Antonella Pucca, I think we've come to the end of our time together here today. I'd like to invite you to say any closing remarks, make any closing remarks that you'd like to before we bid adieu.
Well, I wish to thank you, Bob, for your kind invitation to participate and in this program and have a chance to talk about these topics which are close to my heart. And I also wish to thank the audience for being with us today. I think we are in a very interesting time for being in the finance industry. I think we are very fortunate to be here, to be part of all the new developments that are taking place. And I think part of the challenge is this is a profession that keeps changing. I've been in it for 20 years plus at this point, and part of the challenge is to keep changing with it so that we can stay relevant and understand what is happening around us.
Yes, and Antonella, I do want to thank you for really helping to demystify much of the uncertainty surrounding this topic. I mean, this is a challenging topic, and again, thank you so much for your insights.